Something big is happening in the housing market, and hardly anyone is talking about it. Home prices are quietly shifting, mortgage rates are dropping fast, and what is going to happen next, I believe, will completely change who can afford to buy a home in America. So before you make your next move, whether you're buying, selling, or just watching from the sidelines, you need to see this. Because what I'm about to show you might flip everything you thought you knew about the housing market upside down. I'm also going to show you my trick to pay off your mortgage in half the time. Now take a look at this map. Here are the metro areas where home prices have fallen over the past 12 months. So if the bubble is darker red, that means prices have dropped more sharply in that area. And you can check the scale up there in the top left corner. Now, if you look closely, you'll notice a pattern. Most of the declines are coming from the South and the West Coast, so Florida, parts of Texas, Arizona, California. These markets were some of the hottest during the boom, and now they're seeing the pullback first. And that's really just how cycles work. The markets that rise the fastest tend to cool off the fastest. It's no different than the stock market, where areas that surge 50, 100, 200% usually get hit the worst when things turn. But now let's flip it. These are the metro areas where home prices have gone up over the past year. Same idea. Darker blue bubbles mean stronger gains. And what do you see? Well, the strength is concentrated in the Midwest and the Northeast. Markets like Cleveland, Pittsburgh, Chicago, even parts of upstate New York. Now, in total, out of the largest 300 metro areas in the U.S., home prices have risen in 195 and fallen in 105. So even though you'll hear stories of price drops in certain states, the broader picture is still leaning positive. Now, zooming out to the national average, home prices are up 1.7% over the past 12 months. And now listen, if home prices are down in your area, trust me, I believe you. You might be seeing a 10% drop locally, especially in these overheated markets. But that means somewhere else, prices are up 11 or 12%, and it all averages out nationally. That's the key thing to remember. Real estate is local, but the national story is still one of resilience and not collapse. All right, so let's shift gears to mortgage interest rates, the big driver, because this is where things start to get really interesting. Now, mortgage rates have been falling, but let's unpack why that's happening and how much further they could drop. So here's the chart of the average 30-year fixed mortgage. We're currently sitting near 6% right now for top credit buyers. Obviously, this is nowhere near the 3 and even sub 3% rates people locked in a few years back during the pandemic. But compared to where we were, around 8% in late 2023, this is a major improvement. And more importantly, the trend is down. Now, why are rates falling? Well, a couple of reasons. The Federal Reserve has started cutting rates, and inflation has cooled off compared to 2 or 3 years ago. But before we jump to conclusions, let's clear up a common misconception. The Federal Reserve does not directly control mortgage rates. When they cut rates, what they are cutting is the rate on short-term debt, Treasury bills, mainly the overnight lending rate between banks. Mortgage rates, on the other hand, move more with the 10 and 20-year Treasury yield. So when the Fed cuts, it does help lower yields somewhat, and that in turn nudges mortgage rates down. It's sort of that trickle-down effect, but it is not a one-to-one relationship. And that is why we are seeing a gradual decline, not a free fall. Another important thing to note is markets price in these cuts based on expectations of the Fed. We just got through a Fed meeting where the Federal Reserve cut interest rates by 25 basis points, 0.25%. Mortgage rates, bond rates have not gone down since he made that announcement. In fact, they've trickled up just barely. And the reason is that was priced into the market. The rates came down ahead of that meeting in anticipation of it. So really important to note, if you're shopping or looking to lock in a mortgage, don't say, let me wait to see what the Fed does and then do it. If the overall market believes that he's going to cut and you see rates coming down in anticipation of that, usually right before the meeting is one of the best times to do it. Now, here's where things get interesting. Okay, the Fed's tightening cycle is basically over. They are coming out saying that they're going to be done by the end of November. So Fed tightening simply means they've been buying up assets, taking money out of the market, tightening financial conditions. But from here, what they're going to do is obviously continue cutting, which they've stated, and starting December 1st, return to a policy of quantitative easing, buying stuff, putting money into the market, obviously by printing, and that's going to go into 2026. And every time they launch one of these easing cycles, it gets bigger. It takes more money to keep this massive system afloat. And it usually happens after something breaks, whether it's banks, commercial real estate, stock market, whatever. It's just what needs saving. Let's pump a bunch of money into it. So what does that mean for you and for me? Well, it means mortgage interest rates are likely to keep falling, at least in the short term. And I consider that basically through mid to late 2026. And when rates drop meaningfully, my definition of this, I think if you see 5%, you jump on it. That is your window of opportunity. There will be probably, a few months you can refinance your loan, 5%, 5.25%, maybe 4.75. You get really lucky and have a good relationship with the bank. But you don't want to wait too long, because once they start this easing, they are essentially expanding their balance sheet, pumping money out, buying stuff. That has always and will always cause inflation. It's going to come roaring back. And that's just how this price cycle works. They print money to fight some problem. That causes inflation. They push yields up to fight the inflation, and mortgage rates come up. The reason we had this once-in-a-generation opportunity to get a 2.75 or a 3% mortgage in 2020 was the economy was in such dire straits. They printed trillions and trillions of dollars, pumped them into the market, slashed interest rates down to zero, anything to stimulate the economy. And of course, that caused the inflation that we saw in 21 and 22. They ratcheted the rates back up to tighten the economy. They've been sucking money out of the system to try to control that inflation. And so it just is kind of an ebb and flow. So if it were me, I'd try to lock in that window. Again, my estimate would be mid to late 2026. Now, if you're one of those lucky ones sitting on a 3% or sub 3% mortgage, number one, I hate you. But number two, listen, you got a tough decision on your hands. It is really hard to let go of a 3% mortgage and go in and lock in even a 5% mortgage. But that's a decision you've got to make on your own. So let's talk about what's going to happen with housing prices. Okay? Now, let's just think through this logically. If the Fed cuts rates, starts printing trillions again, that is inflationary. And when inflation rises, prices on everything go up. Food, utilities, cars, and yes, housing. So for that reason, I do not expect a home price crash. If anything, I believe we will see home prices rise further because cheap money and inflation push values higher. And people ask, well, Ross, if home prices keep going up, who the heck's going to be able to afford one? And that's the problem. Most people won't, at least if you don't own a home now. And it's one of the reasons I think everyone always say own assets. You want to own a home because look, if you buy a house today, let's say it's $500,000 and home prices double to $1 million. Well, that next house you get is $1 million, but you've made $500 on your home. So it's like whatever you're locked into, you can maintain that level of home, that level of lifestyle, because no matter how much home prices rise, you're both making it on the one you own and then just spending it on the next one. If you don't, on the other hand, here's what you're subject to. The big dirty investors on Wall Street, BlackRock, Invitation Homes, private equity, they got plenty of money and they'll own all the houses and they'll just rent them out. So if you can buy now, I would. I believe affordability is going to get worse. I know it's not what you want to hear, but that's what the math says. And when that happens, the average buyer gets priced out and the institutions take over the rental game. Now, maybe there's going to be some foreclosures. Right now, are they ticking up? Yes, and that's not surprising. Despite what the headlines say, the economy is weak in certain areas. It's not as strong as they might have you believe. Unemployment may look low on paper, but I think the labor market is weaker than reported. And the whole reason Jerome Powell and the Fed are cutting rates is because the labor market is weakening. And basically, income growth has not kept pace with inflation. This is the whole idea of stagflation. Prices go up, but wages do not. And here's the key. Even though foreclosures are rising, they are but a fraction of what we saw before the 2008 crash. Look at this chart. We're not even back to 2005 levels, let alone 2008. So if you're sitting around waiting for a massive foreclosure spike that's going to crash houses, you're going to be waiting for a while. So that's why I believe if you can buy a home right now, I would, because waiting for the perfect bottom usually means missing the entire move. Now, I also want to show you a trick for paying off your mortgage quickly. We're going to go to a basic mortgage calculator. This is calculator.net. Just uses an amortization table. You put in the loan amount, how many years you're going to be paying on it, etc. So let's just say you had a $500,000 mortgage, right? Over a 30-year term at current interest rates of around 6.5%. Okay, so if you had that, and we're not including insurance and property taxes, that varies greatly by region, so you'll have to add that in. But here's what the payments would be. So as you can see here, your payment would be, what is that? $3,160 basically, right? $3,160 with interest and principal. Okay, your payment's the same for the entire 30 years. Every single month. The only thing that changes is less of it goes towards interest and more of it goes towards the principal balance. But here's the trick. What you want to do is take, and not everyone can do this, but if you can, I strongly encourage you to take your total principal and interest payment, not the taxes, not the insurance, just the principal and interest. So like we said, in this case, that's $3,160. And divide that by 3. Okay, so 3,160 divided by 3 is, I'm just going to do the math in my head, what, 1050, 1055, something like that. It's about $1,050, okay? If you can't afford it. Now, again, remember, your mortgage is $3,160. You also have taxes. You also have insurance. So really, you're probably at about $4,000 a month. So if you can go up just a little bit from $4,000 to $5,000 and pay that once per month, like right in the middle of your either on your mortgage payment or mid-cycle. So if you normally pay your mortgage on the 1st, add this $1,050 on the 15th. So we're just going to put an extra $1,050. And I know for some people this is not possible. If that's the case and you're stretched, I get it. But if you can do this, look at the difference. So you're going from about a $4,000 mortgage to a $5,000 mortgage, 20% bump. But it cuts off half of your mortgage. You pay this thing off in 15 and a half years compared to 30. So 20% increase on payment, 50% decrease in time to own it. And even if you can't go all the way here, let's say you can just add one extra sixth. So you got a $4,000 payment, you can add $500 more a month, okay? Even just doing that is going to cut your 30-year mortgage down to 20 and a half years. You're still taking a third of the time. 10 years mortgage-free for that $500 monthly sacrifice. And so if this is something you can do, I get a little bit more aggressive with it. I actually double my mortgage payment. I know I'm fortunate to be able to do that. Not all of us can. But if you can put a few extra bucks that mortgage each month, I think you will be astounded at the compounding effect of that. Now, one last thing on homeownership is the ongoing debate of renting versus owning. People say, well, if you buy a house, you're losing because you're paying property taxes, you're paying maintenance, you're paying insurance. Listen to me. If you rent, you're still paying those costs. Your landlord just passes them along through higher rent. At least when you own, you're paying toward your own asset and not someone else's. So is buying a house a get-rich-quick play? Only if you time it perfectly in a hot market. For most of us, it's a long-term protection against inflation. You are locking in your rent for the next 15, 20, 30 years. It's about control, it's about stability, and it's about owning something real. And it is also, for most people, a highly leveraged investment. So let's take that $500,000 house again. Let's say you put 20% down on it. What you are doing, in essence, is investing in real estate at 5-to-1 leverage. So if the price of that home appreciates by 20% while you live there, you're essentially making a 100% return on your down payment, on your cash. Now, obviously, again, this is oversimplified. It doesn't take into account taxes and insurance and realtor commissions, et cetera, but you get the idea. And this is why, for a lot of the middle class, a large portion of their net worth is in their home's equity. And it's also just a forced savings account. You got to pay your mortgage every month unless you want to live on the street, and the principal portion of that is building up additional equity in your home. So To wrap this up, I hope for affordable housing. I hope for a strong job market, a healthy economy. But looking at the data and the trends, I just don't see that happening in 2026. And that's my honest take. So let me know what you think. I'd love to hear your thoughts. If you found this helpful, make sure to like and subscribe. Stay tuned for more market updates, and I'll see you in the next one.